Introduction. The Alpha game. The first hedge fund manager, Alfred Winslow Jones, did not go to business school. He did not possess a PhD in quantitative finance. He did not spend his formative years at Morgan Stanley, Goldman Sachs, or any other incubator for masters of the universe. Instead, he took a job on a tramp steamer, studied at the Marxist Workers' School in Berlin, and ran secret missions for a clandestine anti-Nazi group called the Leninist Organization. He married, divorced, and married again, honeymooning on the front lines of the Civil War in Spain, traveling and drinking with Dorothy Parker and Ernest Hemingway. It was only at the advanced age of 48 that Jones raked together $100,000 to set up a hedged fund, generating extraordinary profits through the 1950s and 1960s. Almost by accident, Jones improvised an investment structure that has endured to this day. It will thrive for years to come, despite a cacophony of naysayers. Half a century after Jones created his hedge fund, a young man named Clifford Asness followed in his footsteps. Asness did attend a business school. He did acquire a PhD in quantitative finance. He did work for Goldman Sachs, and he was a master of the universe. Whereas Jones had launched his venture in his mature, starched collar years, Asness rushed into the business at the grand old age of 31, beating all records for a new startup by raising an eye-popping $1 billion. Whereas Jones had been discreet about his methods and the riches that they brought, Asness was refreshingly open, tearing up his schedule to do TV interviews and confessing to the New York Times that it doesn't suck to be worth millions. Won by the eve of the subprime mortgage crash in 2007, Asness's firm, AQR Capital Management, was running a remarkable $38 billion, and Asness himself personified the new globe-changing finance. He was irreverent, impatient, and scarcely even bothered to pretend to be grown up. He had a collection of plastic superheroes in his office too. Asness freely recognized his debt to Jones's improvisation. His hedge funds, like just about all hedge funds, embraced 4 features that Jones had combined to spectacular effect. To begin with, there was a performance fee. Jones kept 1/5 of the fund's investment profits for himself and his team, a formula that sharpened the incentives of his lieutenants. Next, Jones made a conscious effort to avoid regulatory red tape, preserving the flexibility to shape-shift from one investment method to the next as market opportunities mutated. But most important, from Asness's perspective, were 2 ideas that had framed Jones's investment portfolio. Jones had balanced purchases of promising shares with short selling of unpromising ones, meaning that he borrowed and sold them, betting that they would fall in value. By being long some stocks and short others, he insulated his fund at least partially from general market swings. And having hedged out market risk in this fashion, he felt safe in magnifying, or leveraging, his bets with borrowed money. As we will see in the next chapter, this combination of hedging and leverage had a magical effect on Jones's portfolio of stocks, but its true genius was the one that Asness emphasized later. The same combination could be applied to bonds, futures, swaps, and options, and indeed to any mixture of these instruments. More by luck than by design, Jones had invented a platform for strategies more complex than he himself could dream of. No definition of hedge funds is perfect, and not all the adventures recounted in this book involve hedging and leverage. When George Soros and Stan Druckenmiller broke the British pound, or when John Paulson shorted the mortgage bubble in the United States, there was no particular need to hedge. As we shall see later, when an intrepid commodities player negotiated the purchase of the Russian government's entire stock of non-gold precious metals, leverage mattered less than the security around the armored train that was to bring the palladium from Siberia. But even when hedge funds are not using leverage and not actually hedging, the platform created by W. Jones has proved exceptionally congenial. The freedom to go long and short in any financial instrument in any country allows hedge funds to seize opportunities wherever they exist. The ability to leverage allows hedge funds to size each bet to maximum effect. Performance fees create a powerful incentive to coin money. Ah yes, that money. At his death in 1913, J. Pierpont Morgan had accumulated a fortune of $1.4 billion in today's dollars, earning the nickname Jupiter because of his godlike power over Wall Street. But in the bubbly first years of this century, the top hedge fund managers amassed more money than God in a couple of years of trading. They earned more, vastly more, than the captains of Wall Street's mightiest investment banks and eclipsed even private equity barons. In 2006, Goldman Sachs awarded its chief executive, Lloyd C. Blankfein, an unprecedented $54 million. But the bottom guy on Alpha magazine's list of the top 25 hedge fund earners reportedly took home $240 million. That same year, the leading private equity partnership, Blackstone Group, rewarded its boss, Stephen Schwarzman, with just under $400 million. But the top 3 hedge fund moguls each were said to have earned more than $1 billion. Point 3. The compensation formula devised by Jones conjured up hundreds of fast fortunes, not to mention hundreds of fast cars in the suburbs of Connecticut. reporting from the epicenter of this gold rush. The Stamford Advocate observed that 6 local hedge fund managers had pocketed a combined $2.15 billion in 2006. The total personal income of all the people in Connecticut came to $150 billion. In the 1990s, magazines drooled over the extravagance of dot-com millionaires, but now the spotlight was on hedge funds. Ken Griffin, the creator of Citadel Investment Group, bought himself a $50 million Bombardier Express private jet and had it fitted with a crib for his 2-year-old. Louis Bacon, the founder of More Capital, acquired an island in the Great Peconic Bay, put transmitters on the local mud turtles to monitor their mating habits, and hosted traditional English pheasant shoots. Stephen Cohen, the boss of Sac Capital, equipped his estate with a basketball court, an indoor pool, a skating rink, a 2-hole golf course, an organic vegetable plot, paintings by Van Gogh and Pollock, a sculpture by Keith Haring, and a movie theater decorated with the pattern of the stars on his wedding night 16 years earlier. The hedge fund titans were the new Rockefellers, the new Carnegies, the new Vanderbilts. They were the new American elite, the latest act in the carnival of creativity and greed that powers the nation forward. And what an elite this was. Hedge funds are the vehicles for loners and contrarians, for individualists whose ambitions are too big to fit into established financial institution. Cliff Asness is a case in point. He had been a rising star at Goldman Sachs, but he opted for the freedom and rewards of running his own shop. A man who collects plastic superheroes is not going to remain a salaried anti-hero for long. At least not if he can help it. Jim Simons of Renaissance Technologies, the mathematician who emerged in the 2000s as the highest earner in the industry, would not have lasted at a mainstream bank. He took orders from nobody, seldom wore socks, and got fired from the Pentagon's code-cracking center after denouncing his boss's Vietnam policy. Ken Griffin of Citadel, the second highest earner in 2006, started out trading convertible bonds from his dorm room at Harvard. He was the boy genius made good, the financial version of the entrepreneurs who forged tech companies such as Google. The earliest pioneers of the industry were cut from equally bright cloth. Julian Robertson staffed his hedge fund with college athletes half his age. Then he flew them out to various retreats in the Rockies and raced them up the mountains. Michael Steinhardt was capable of reducing underlings to sobs. "All I want to do is kill myself," one said. "Can I watch?" Steinhardt responded, "For like the Rockefellers and Carnegies before them, the new moguls made their mark on the world beyond business and finance." George Soros was the most ambitious in his reach. His charities fostered independent voices in the emerging ex-communist nations. They pushed for the decriminalization of drugs. They funded a rethink of laissez-faire economics. Paul Tudor Jones, the founder of Tudor Investment Corporation, created Robinhood, one of the first venture philanthropies to fight poverty in New York City. It identified innovative charities, set demanding benchmarks for progress, and paid for performance. Bruce Kovner emerged as a godfather of the neoconservative movement, chairing the American Enterprise Institute in Washington, D.C. Michael Steinhardt bankrolled efforts to create a new secular Judaism. But of course it was in finance that these egos made the most impact. The story of hedge funds is the story of the frontiers of finance, of innovation and increasing leverage, of spectacular triumphs and humiliating falls, and of the debates spawned by these dramas. For much of their history, hedge funds have skirmished with the academic view of markets. Of course, academia is a broad church, teeming with energetic skeptics. But from the mid-1960s to the mid-1980s, the prevailing view was that the market is efficient, prices follow a random walk, and hedge funds succeed mainly by being lucky. There is a powerful logic to this account. If it were possible to know with any confidence that the price of a particular bond or equity is likely to move up, smart investors would have pounced and it would have moved up already. Pouncing investors ensure that all relevant information is already in prices, though the next move of a stock will be determined by something unexpected. It follows that professional money managers who try to foresee price moves will generally fail in their mission. As this critique anticipates, plenty of hedge funds have no real edge. If you strip away the marketing hype and occasional flashes of dumb luck, there is no distinctive investment insight that allows them to beat the market consistently. But for the successful funds that dominate the industry, the efficient market indictment is wrong. These hedge funds could drop their H and be called edge funds. Where does this edge come from? Sometimes it consists simply of picking the best stocks. Despite everything that the finance literature asserts, a W. Jones, Julian Robertson, and many Robertson protégés clearly did add value in this way, as we shall see presently. But frequently the edge consists of exploiting kinks in the efficient market theory that its proponents conceded at the start, even though they failed to emphasize them. The theorists stipulated, for example, that prices would be efficient only if liquidity was perfect. A seller who offers a stock at the efficient price should always be able to find a buyer, since otherwise he will be forced to offer a discount, rendering the price lower than the efficient level. But in the 1970s and 1980s, a big pension fund that wanted to dump a large block of shares could not actually find a buyer unless it offered a discount. Michael Steinhardt made his fortune by milking these discounts in a systematic way. An unassuming footnote in the efficient market view became the basis for a hedge fund legend. The nature of hedge funds' true edge is often obscured by their bosses' pronouncements. The titans sometimes seem like mystic geniuses. They rack up glorious returns but cannot explain how they did it. 5. Perhaps the most extreme version of this problem is presented by the young Paul Tudor Jones. To this day, Jones maintains that he anticipated the 1987 crash because his red suspendered, 20-something colleague, Peter Borish, had mapped the 1980s market against the charts leading up to 1929. Seeing that the two lines looked the same, Jones realized that the break was coming. But this explanation of Jones's brilliant market timing is inadequate, to say the least. For one thing, Borish admitted to massaging the data to make the two lines fit 6 for another. He predicted that the crash would hit in the spring of 1988. If Jones had really followed Borish's counsel, he would have been wiped out when the crash arrived the previous October. In short, Jones succeeded for reasons that we will explore later, not for the reasons that he cites. The lesson is that genius does not always understand itself. A lesson, incidentally, that is not confined to finance. Out of all the research that we've done with top players, we haven't found a single player who is consistent in knowing and explaining exactly what he does. The legendary tennis coach Vic Braden once complained, "They give different answers at different times, or they have answers that simply are not meaningful." 7. Starting in the 1980s, financial academics came around to the view that markets were not so efficient after all. Sometimes their conversions were deliciously perfect. A young economist named Scott Irwin procured an especially detailed price series for commodity markets from a small firm in Indianapolis. And after painstaking analysis, he proclaimed that prices moved in trends. The changes were not random. Little did he know that, almost 20 years earlier, a pioneering hedge fund called Commodities Corporation had analyzed the same data, reached the same conclusion, and programmed a computer to trade on it. Meanwhile, other researchers acknowledged that markets were not perfectly liquid, as Steinhardt had discovered long before, and that investors were not perfectly rational, a truism to hedge fund traders. The crash of 1987 underlined these doubts, when the market's valuation of corporate America changed by a fifth in a single trading day. It was hard to believe that the valuation deserved much deference. If the efficient markets hypothesis was a publicly traded security, its price would be enormously volatile. The Harvard economists Andre Schleifer and Lawrence Summers wrote mockingly in 1990, "But the stock in the efficient markets hypothesis, at least as it has traditionally been formulated, crashed along with the rest of the market on October 19, 1987.8. The acknowledgement of the limits to market efficiency had a profound effect on hedge funds. Before, the prevailing line from the academy had been that hedge funds would fail. After, lines of academics were queuing up to join them. If markets were inefficient, there was money to be made, and the finance professors saw no reason why they should not be the ones to profit. Cliff Asness was fairly typical of the new wave. At the University of Chicago's Graduate School of Business, his thesis advisor was Eugene Fama, one of the fathers of the efficient market hypothesis. But by 1988, when Asness arrived in Chicago, Fama was leading the revisionist charge. Along with a younger colleague, Kenneth French, Fama discovered non-random patterns in markets that could be lucrative for traders. After contributing to this literature, Asness headed off to Wall Street and soon opened his hedge fund. In similar fashion, the Nobel laureates Myron Scholes and Robert Merton, whose formula for pricing options grew out of the efficient market school, signed up with the hedge fund long-term capital management. Andre Schleifer, the Harvard economist who had compared the efficient market theory to a crashing stock, helped to create an investment company called LSV with two fellow finance professors. His co-author, Lawrence Summers, made the most of a gap between stints as president of Harvard and economic advisor to President Obama to sign on with D.E. Shaw, a quantitative hedge fund 9. Yet the biggest effect of the new and efficient market consensus was not that academics flocked to hedge funds. It was that institutional investors acquired a license to entrust vast amounts of capital to them. Again, the years after the 1987 crash were an inflection point. Before, most money in hedge funds had come from rich individuals, who presumably had not heard academia's message that it was impossible to beat the market. After, most money in hedge funds came from endowments, which had been told by their learned consultants that the market could be beaten, and which wanted in on the action. The new wave was led by David Swensen, the boss of the Yale Endowment, who focused on two things. If there were systematic patterns in markets of the sort that Fama, French, and Asness had identified, then hedge funds could milk these in a systematic way. There were strategies that could be expected to do well, and they could be identified prospectively. Further, the profits from these strategies would be more than just good on their own terms. They would reduce an endowment's overall risk through the magic of diversification. The funds that Swenson invested in were certainly diverse. In 2002, a swashbuckling West Coast fund named Farallon swooped into Indonesia and bought the country's largest bank, undeterred by the fact that a currency collapse, a political revolution, and Islamist extremism had scared most Westerners out of the country. Following Swenson's example, endowments poured money into hedge funds from the 1990s on, seeking the uncorrelated returns that endowment gurus called alpha. The new and efficient market view also imbued hedge funds with a social function. This was the last thing they had sought. They had gotten into the alpha game with one purpose above all, and that was to make money. But if alpha existed because markets were inefficient, it followed that savings were being allocated in an irrational manner. The research of Fama and French, for example, showed that unglamorous value stocks were underpriced relative to overhyped growth stocks. This meant that capital was being provided too expensively to solid, workhorse firms and too cheaply to their flashier rivals. Opportunities for growth were being squandered. Similarly, the discounts in block trading showed that prices could be capricious in small ways, raising risks to investors, who in turn raised the premium that they charged to users of their capital. It was the function of hedge funds to correct inefficiencies like these. By buying value stocks and shorting growth stocks, Cliff Asness was doing his part to reduce the unhealthy bias against solid, workhorse firms. By buying Ford stock when it dipped illogically after a large block sale, Michael Steinhardt was ensuring that the grandma who owned a piece of Ford could always count on getting a fair price for it. By computerizing Steinhardt's art, statistical arbitrageurs such as Jim Simons and David Shaw were taking his mission to the next level. The more markets could be rendered efficient, the more capital would flow to its most productive uses. The less prices got out of line, the less risk there would presumably be of financial bubbles, and so of sharp, destabilizing corrections. By flattening out the kinks in market behavior, hedge funds were contributing to what economists called the Great Moderation. But hedge funds also raised an unsettling question. If markets were prone to wild bubbles and crashes, might not the wildest players render the turbulence still crazier? In 1994, the Federal Reserve announced a tiny 1/4 of a percentage point rise in short-term interest rates, and the bond market went into a mad spin. Leveraged hedge funds had been wrong-footed by the move, and they began dumping positions furiously. Foreshadowing future financial panics, the turmoil spread from the United States to Japan, Europe, and the emerging world. Several hedge funds sank, and for a few hours it even looked as though the storied firm of Bankers Trust might be dragged down with them. As if this were not warning enough, the world was treated to another hedge fund failure 4 years later, when long-term capital management and its crew of Nobel laureates went bust. Terrified that a chaotic bankruptcy would topple Lehman Brothers and other dominoes besides, panicked regulators rushed in to oversee LTCM's burial. Meanwhile, hedge funds wreaked havoc with exchange rate policies in Europe and Asia. After the East Asian crisis, Malaysia's Prime Minister, Mahathir Mohamad, lamented that all these countries have spent 40 years trying to build up their economies, and a moron like Soros comes along with a lot of money to speculate and ruins things 10 and so. By the start of the 21st century, there were two competing views of hedge funds. Sometimes the funds were celebrated as the stabilizing heroes who muscled inefficient prices into line. Sometimes they were vilified as the weak links whose own instability or wanton aggression threatened the global economy. The heart of the matter was the leverage embraced by a W. Jones, or rather, a vastly expanded version of it. Leverage gave hedge funds the ammunition to trade in greater volume, and so to render prices more efficient and stable. But leverage also made hedge funds vulnerable to shocks. If their trades moved against them, they could burn through thin cushions of capital at lightning speed, obliging them to dump positions fast, destabilizing prices 11 after the bond market meltdown of 1994 and the long-term capital failure in 1998. The two competing views of hedge funds wrestled to a stalemate. In the United States and Britain, hedge funds' stabilizing impact received the most emphasis. Elsewhere, the risk of destabilizing panics got most of the attention. Funnily enough, the countries that liked hedge funds the best were also the ones that hosted them. Then came the crisis of 27209, and every judgment about finance was thrown into question. Whereas the market disruptions of the 1990s could be viewed as a tolerable price to pay for the benefits of sophisticated and leveraged finance, the convulsion of 27209 triggered the sharpest recession since the 1930s. Inevitably, hedge funds were caught up in the panic. In July 2007, A credit hedge fund called Sowed blew up, and the following month a dozen or so quantitative hedge funds tried to cut their positions all at once, triggering wild swings in the equity market and billions of dollars of losses. The following year was more brutal by far. The collapse of Lehman Brothers left some hedge funds with money trapped inside the bankrupt shell, and the turmoil that followed inflicted losses on most others. Hedge funds needed access to leverage, but nobody lent to anyone in the weeks after the Lehman shock. Hedge funds built their strategies on short selling, but governments imposed clumsy restrictions on shorting amid the post-Lehman panic. Hedge funds were reliant upon the patience of their investors, who could yank their money out on short notice. But patience ended abruptly when markets went into a tailspin. Investors demanded their capital back, and some funds withheld it by imposing gates. Surely now it was obvious that the risks posed by hedge funds outweighed the benefits. Far from bringing about the great moderation, they had helped to trigger the great cataclysm. This conclusion, though tempting, is almost certainly mistaken. The cataclysm has indeed shown that the financial system is broken, but it has not actually shown that hedge funds are the problem. It has demonstrated, to begin with, that central banks may have to steer economies in a new way. Rather than targeting consumer price inflation and turning a blind eye to asset price inflation, they must try to let the air out of bubbles. A lesson first suggested, incidentally, by the hedge fund blowup of 1994. If the Fed had curbed leverage and raised interest rates in the mid-2000s, there would have been less craziness up and down the chain. American households would not have increased their borrowing from 66% of GDP in 1997 to 100% a decade later. Housing finance companies would not have sold so many mortgages regardless of borrowers' ability to repay. Fannie Mae and Freddie Mac, the two government-chartered home lenders, would almost certainly not have collapsed into the arms of the government. Banks like Citigroup and broker-dealers like Merrill Lynch would not have gorged so greedily on mortgage-backed securities that ultimately went bad, squandering their capital. The Fed allowed this binge of borrowing because it was focused resolutely on consumer price inflation, and because it believed it could ignore bubbles safely. The carnage of 7209 demonstrated how wrong that was. Presented with an opportunity to borrow at near zero cost, people borrowed unsustainably. The crisis has also shown that financial firms are riddled with dysfunctional incentives. The clearest problem is too big to fail. Wall Street behemoths load up on risk because they expect taxpayers to bail them out, and other market players are happy to abet this recklessness because they also believe in the government backstop. But this too-big-to-fail problem exists primarily at institutions that the government has actually rescued: commercial banks such as Citigroup, former investment banks such as Goldman Sachs and Morgan Stanley, insurers such as AIG, the money market funds that received an emergency government guarantee at the height of the crisis. By contrast, hedge funds made it through the mayhem without receiving any direct taxpayer assistance. There is no precedent that says that the government stands behind them. Even when long-term capital collapsed in 1998, the Fed oversaw its burial but provided no money to cover its losses. At some point in the future, a supersized hedge fund may prove to be too big to fail, which is why the largest and most leveraged should be subject to regulation. But the great majority of hedge funds are too small to threaten the broader financial system. They are safe to fail, even if they are not fail-safe. 12. The other skewed incentive in finance involves traders' pay packages. When traders take enormous risks, they earn fortunes if the bets pay off. But if the bets go wrong, they don't endure symmetrical punishment. The performance fees and bonuses dry up, but they do not go negative. Again, this heads-I-win tails-you-lose problem is sharper at banks than at hedge funds. Hedge funds tend to have high water marks. If they lose money one year, they take reduced or even no performance fees until they earn back their losses. Hedge fund bosses mostly have their own money in their funds, so they are speculating with capital that is at least partly their own, a powerful incentive to avoid losses. By contrast, bank traders generally face fewer such restraints. They are simply risking other people's money. Perhaps it is no surprise that the typical hedge fund is far more cautious in its use of leverage than the typical bank. The average hedge fund borrows only 1 or 2 times its investors' capital, and even those that are considered highly leveraged generally borrow less than 10 times. Meanwhile, investment banks such as Goldman Sachs or Lehman Brothers were leveraged 30-to-1 before the crisis, and commercial banks like Citi were even higher by some measures. 13. The very structure of hedge funds promotes a paranoid discipline. Banks tend to be establishment institutions with comfortable bosses. Hedge funds tend to be scrappy upstarts with bosses who think nothing of staying up all night to see a deal close. Banks collect savings from households with the help of government deposit insurance. Hedge funds have to demonstrate that they can manage risk before they can raise money from clients. Banks know that if they face a liquidity crisis, they have access to the central bank's emergency lending, so they are willing to rely heavily on short-term loans. Hedge funds have no such safety net, so they are increasingly reluctant to depend on short-term lending. Banks take the view that everything is going wonderfully so long as borrowers repay. Hedge funds mark their portfolios to market, meaning that slight blips in the risk that borrowers will hit trouble in the future can affect the hedge fund's bottom line immediately. 14 Banks' investment judgment is often warped by their pursuit of underwriting or advisory fees. Hedge funds live and die by their investment performance, so they are less distracted and conflicted. For all these reasons, a proper definition of hedge funds should stress their independence. So-called hedge funds that are the subsidiaries of large banks lack the paranoia and focus that give true hedge funds their special character. As I finished writing this book, in early 2010, regulators seemed poised to clamp down on the financial industry. To a large extent, their instincts were right. At their peak, financial companies hogged more human capital than they deserved, and they took risks that cost societies dearly. But Wall Street's critics should pause before they sweep hedge funds into their net. Who, in the final analysis, will manage risk better? Commercial banks and investment banks, which either blew up or were bailed out by the government. Mutual fund companies, which peddled money market products that the government was forced to backstop. And which sort of future do the critics favor? One in which risk is concentrated inside giant banks for which taxpayers are on the hook, or one in which risk is dispersed across smaller hedge funds that expect no lifelines from the government. The crisis has compounded the moral hazard at the heart of finance. Banks that have been rescued can expect to be rescued all over again the next time they blow up. Because of that expectation, they have weak incentives to avoid excessive risks, making blow-up all too likely. Capitalism works only when institutions are forced to absorb the consequences of the risks that they take on. When banks can pocket the upside while spreading the cost of their failures, failure is almost certain. If they are serious about learning from the 7209 crisis, policymakers need to restrain financial supermarkets with confused and overlapping objectives, encouraging focused boutiques that live or die according to the soundness of their risk management. They need to shift capital out of institutions underwritten by taxpayers and into ones that stand on their own feet. They need to shrink institutions that are too big to fail and favor ones that are small enough to go under. The story of W. Jones and his successors shows that a partial alternative to banking supermarkets already exists. To a surprising and unrecognized degree, the future of finance lies in the history of hedge funds. Chapter 1: Big Daddy. At the dawn of America's second Gilded Age, and on the eve of the 21st century's first financial crash, the managers of a few dozen hedge funds emerged as the unofficial kings of capitalism. Globalization was generating unheralded prosperity, and the prosperity was generating deep pools of wealth. And the wealth was being parked in quiet funds, whose managers profited mightily. Just in the 3 years from 2003 to 2006, the volume of money in the top 100 hedge funds doubled to $1 trillion, so enough to buy all shares listed on the Shanghai Stock Exchange or an entire year's worth of output from the Canadian economy. Nobody doubted that this hedge fund phenomenon was new, unprecedented, and symbolic of the era. Running a few $100 million for a hedge fund and taking tens of millions for yourself has become the going Wall Street dream. One magazine writer declared 2 hedge funds are the ultimate in today's stock market, the logical extension of the current gunslinging, go-go cult of success. According to another 3, but hedge funds are not new and not unprecedented. And whereas the first line just quoted comes from a New York Magazine article published in 2004, the second comes from a remarkably similar essay, also in New York Magazine, published 4 decades earlier. The 2004 article gushed that hedge fund managers are the type who can call the direction of the market correctly 22 days in a row. The 1968 version invoked the hedge fund guy who made 20% on his money in a week for 7 weeks in a row. The 2004 essay complained of hedge funds that in addition to being arrogant and insular, they're also clandestine. The 1968 version said peevishly that most people involved in hedge funds are reluctant to talk about their success. If hedge fund managers had emerged as the it boys of the new century, if they had supplanted the leveraged buyout barons of the 1980s and the dot-com wizards of the 1990s, it was worth remembering that they were also the hot stars of an earlier era. A hedge fund manager can be away from the market and still know where its rhythm and his are meshing. According to a famous account of the 1960s boom, if you really know what's going on, you don't even have to know what's going on to know what's going on. You can ignore the headlines, because you anticipated them months ago. For the largest legend of the first hedge fund era was Alfred Winslow Jones, the founding father whom we have encountered already. He was described in New York Magazine's 1968 essay as the big daddy of the industry. But he was an unlikely Wall Street patriarch. Like many of the hedge fund titans of a future age, he changed the nature of finance while standing somewhat aloof from it. In 1949, when Jones invented his hedge fund, the profession of money management was dominated by starchy, conservative types. known tellingly as trustees. Their job was merely to conserve capital, not to seek to grow it. The leading money management companies had names like Fidelity and Prudential, and they behaved that way too. A good trustee was, in the words of the writer John Brooks, a model of unassailable probity and sobriety, his white hair neatly but not too neatly combed, his blue Yankee eyes untwinkling 5. But Jones was cut from different cloth. By the time he turned his hand to finance, he had experimented restlessly with multiple careers. He kept the company of writers and artists, not all of them sober, and although he was to become the father of hypercapitalist hedge funds, he had spent a good portion of his youth flirting with Marxism. Jones was born in the 9th hour of the 9th day of the 9th month of 1900, a fact with which he would bore his family years later. 6. He was the son of an expatriate American who ran the Australian operations of General Electric. According to Jones' family lore, they owned the first car in Australia. A formal photograph from the time shows the 3-year-old Alfred wearing a white sailor cap with a white jacket. On one side of him sits his father in a stiff, winged collar. On the other side is his mother in an elaborate feathered hat. After the family returned to G's company headquarters in Schenectady, New York, Alfred went to school there and followed in the family tradition by attending Harvard. But when he graduated in 1923, he was at a loss for what to do. None of the obvious career paths for a gifted scion of the Ivy League appealed to him. The jazz age was beginning its ascent. F. Scott Fitzgerald was conjuring the dissolute anti-heroes of The Great Gatsby. Slim, tall, with soft features and thick hair, Jones would have fitted into Fitzgerald's world with little difficulty. But Jones had other ideas about his life. Having inherited the wanderlust of his father, he signed on as a purser on a tramp steamer and spent a year touring the world. He took a job as an export buyer and another as a statistician for an investment counselor. And then, after drifting aimlessly some more, he took the Foreign Service exam and joined the State Department. 7. Jones was immediately posted to Berlin, arriving as America's vice consul in December 1930. Germany's economy was in free fall. Output had shrunk 8% that year, and unemployment stood at 4.5 million. In the elections 3 months earlier, the little-known National Socialist Party had capitalized on popular fury, winning 107 seats in the Reichstag. 8. Jones's work brought him face to face with Germany's troubles. He wrote 2 studies on the conditions of Germany's workers, one dealing with their access to food and a second with housing. But his engagement with Germany became intense when he met Anna Bloch, a socialite and left-wing anti-Nazi activist. The daughter of a Jewish banking family, Anna was attractive, flirtatious, and resourceful. For a while she escaped Nazi detection by operating out of the maternity wing of a Berlin hospital, and years later, when she was involved in the Paris underground, she bet that she could bluff her way into the finest London hotel, equipped only with a cardboard box as her luggage. When Jones met Anna in 1931, she was working for a group called the Leninist Organization and bent on finding a third husband. Captivated by Anna's heady mix of socialist engagement and bourgeois charm, Jones became the servant of her purposes. Political and personal. 9. Jones married Anna in secret, but the union was soon discovered by his embassy colleagues. The breach forced his resignation from the State Department in May 1932, just a year and a half after joining. But his involvement with Germany did not end there. He returned to Berlin in the fall of 1932, operating under the pseudonym Richard Frost and working secretly for the Leninist Organization. 10. The next year he represented the group in London, assuming the cover name H.B. Wood and seeking to persuade the British Labour Party, which was tinged with pacifism, to wake up to the need for military action against Hitler. The British authorities grew suspicious of Jones's activities, all the more so when they discovered that he had attended the Marxist Workers' School in Berlin, which was organized by the German Communist Party. It is understood that Mr. Jones expressed an interest in communism while connected with the Foreign Service. A State Department official wrote in response to an urgent query from London. 11. The German resistance to Hitler proved more romantic than practical. The same could also have been said of Jones's relationship with Anna. The couple divorced after a few months, and Jones left London for New York in 1934. Enrolling as a graduate student in sociology at Columbia University and marrying Mary Elizabeth Carter, a middle-class plantation girl from Virginia. 12. But if Jones's life seemed to be shifting into conventional channels, the shift was not complete. He maintained his connections to the German left through the 1930s and early 1940s and may have been involved in U.S. intelligence operations. 13. After his marriage to Mary, he set off in 1937 for a honeymoon in war-torn Spain. 14. The newlyweds hitchhiked to the front lines with the writer Dorothy Parker. They encountered Ernest Hemingway, who treated them to a bottle of Scotch whiskey. The disintegration of Europe that Jones had witnessed, first in Germany and then in Spain, was an extreme version of the turmoil in his own country. The America of The Great Gatsby had given way to the America of John Steinbeck's The Grapes of Wrath. The Jazz Age had given way to the Depression. On Wall Street, the crash of October 1929 was followed by a series of collapses in the early 1930s. Investors fled the market in droves, and the bustling brokerages fell quiet. It was said that you could walk the famous canyons near the stock exchange and hear only the rattle of backgammon dice through the open windows 15. But what is striking about Jones, given his youthful adventures with the undercover left, is that he emerged from this turmoil more level-headed than before. He grappled ambitiously with the biggest questions of his age, but his conclusions tended to be moderate. Jones's politics emerged from his writings as a sociologist and journalist. In the late 1930s, as the Nazi menace spread across Europe, Jones plunged into the research for his doctoral thesis, motivated by a desire to understand whether the same calamity could befall his own country. 16. His thesis topic reflected the preoccupation of the political left with class structure. He was bent on teasing out the links between Americans' economic conditions and their attitudes toward property. His purpose was to help find out to what extent, in our basic ideas, we are a united people, and to what extent we are a house divided. 17. In late 1938 and early 1939, Jones decamped with Mary to a hotbed of industrial conflict, Akron, Ohio, and organized a team of assistants to conduct 1,700 field interviews, subjecting his interview results to a series of statistical tests. He concluded that acute economic divisions did not actually carry over into polarized worldviews. It was a repudiation of the socialist assumptions of his youth and a testimony to the vitality of American democracy. Jones's thesis, which appeared as a book titled Life, Liberty and Property in 1941, became a standard sociology textbook. Meanwhile, it served to launch Jones on yet another career, this time as a journalist. Fortune magazine published the thesis in condensed form and also offered Jones a job. He signed on happily, even though he found writing a hard process. In an essay published in 1942, Jones gave warning that Roosevelt's economic statism would need to be dismantled once the war ended. 18. His respect for the market, which confirmed his retreat from socialism toward the political center, was mixed with continued interest in redistributive programs. The ideal, he wrote in Fortune, was a sort of left-right blend, as conservative as possible in protecting the free market and as radical as necessary in securing the welfare of the people. In 1948, a writing assignment for Fortune gave Jones the opportunity to turn his mind to finance, a subject he had largely ignored since his stint with an investment counselor 2 decades earlier. The resulting essay, which appeared in March 1949 under the title Fashions in Forecasting, anticipated many of the hedge funds that came after him. The essay started out by attacking the standard, old-fashioned method of predicting the course of the stock market, which was to examine freight car loadings, commodity prices, and other economic data to determine how stocks ought to be priced. This approach to market valuation failed to capture much of what was going on. Jones cited moments when stocks had shifted sharply in the absence of changed economic data. Having dismissed fundamental analysis, Jones turned his attention to what he believed was a more profitable premise: the notion that stock prices were driven by predictable patterns in investor psychology. Money might be an abstraction, a series of numerical symbols, but it was also a medium through which greed and fear and jealousy expressed themselves. It was a barometer of crowd psychology. 19. Perhaps it was natural that a sociologist should find this hypothesis attractive. Jones believed that investor emotions created trends in stock prices. A rise in the stock market generates investor optimism, which in turn generates a further rise in the market, which generates further optimism, and so on, and this feedback loop drives stock prices up, creating a trend that can be followed profitably. The trick is to bail out at the moment when the psychology turns around, when the feedback loop has driven prices to an unsustainable level, and greed turns to fear, and there is a reversal of the pendulum. The forecasters whom Jones profiled in Fortune offered fresh methods for catching these tipping points. Some believed that if the Dow Jones Index was rising while most individual stocks were falling, the rally was about to peter out. Others argued that if stock prices were rising but trading volume was falling, the bull market was running out of buyers and the tide would soon reverse. All shared the view that stock charts held the secret to financial success, because the patterns in the charts repeated themselves. In his deference to chart-watching forecasters, Jones seemed oddly ignorant of academic economics. In 1933 and 1944, Alfred Cowles, one of the fathers of statistical economics, had published 2 studies reviewing thousands of investment recommendations issued by financial practitioners. The first of these 2 articles was titled "Can Stock Market Forecasters Forecast?" The 3-word abstract answered the question. It is doubtful. Jones cited Cowles's work selectively in Fortune, mentioning in passing that the master had found evidence of trends in monthly prices. He neglected to mention that Cowles had found no trends when he examined prices reported at 3-week intervals. Nor did he say that Cowles had concluded that any appearance of patterns in markets was too faint and unreliable to be traded upon profitably. 20 Yet despite Jones's superficial reading of Cowles, there was at least one point on which the two saw eye to eye. Both believed that successful market forecasters could not sustain their performance. The very act of forecasting a trend was likely to destroy it. Suppose, for example, that a financial seer could tell when an upward trend was going to be sustained for several days until the market hit a certain level. Money would follow this advice, pushing up prices to the predicted level straight away and cutting the trend off in its infancy. In this way, the forecasters would speed up the workings of the market while working themselves out of a job. As Jones concluded in his fortune piece, the price trends would cease. The market would be left to fluctuate in a relatively gentle, orderly way to accommodate itself to fundamental economic changes only. To an extent that he could not possibly have foreseen, Jones was anticipating the history of hedge funds. Over the succeeding decades, wave upon wave of financial innovators spotted opportunities to profit from markets, and many of them found that once their insight had been understood by a sufficient number of investors, the profit opportunity faded because the markets had grown more efficient. In the 1950s and 1960s, Jones himself was destined to impose a new efficiency upon markets. But the nature of that change was not at all what he expected. By the time the Fortune essay appeared in March 1949, Jones had launched the world's first hedge fund. It was not that he had suddenly turned passionate about finance. On the contrary, he was more preoccupied with his political migration from liberalism to socialism and back, and with the pleasures of gardening at his new country home in Connecticut. 21 But now in his late 40s, with 2 children and expensive New York tastes, he decided that he needed money. 22 His efforts to earn more in journalism had fizzled. He had left the staff of Fortune hoping to launch a new magazine, but 2 blueprints had failed to attract financial backing. Stymied in these publishing ventures, Jones moved to Plan B. He raised $60,000 from 4 friends and put up $40,000 of his own to try his hand at investing. Jones's investment record over the next 20 years was one of the most remarkable in history. By 1968 he had racked up a cumulative return of just under 5,000%, meaning that the investor who had given him $10,000 in 1949 was now worth a tidy $480,000.23. He left his competitors in the dust. For instance, in the 5 years to 1965 he returned 325%, dwarfing the 225% return on the hottest mutual fund for that period. In the 10 years to 1965, Jones earned almost 2 times as much as his nearest competitor, 24 by some measures. Jones's performance in these years rivaled even that of Warren Buffett. 25 Jones's investment venture started out in a shabby 1.5-room office on Broad Street. He rented space from an insurance business owned by one of his investors, Winslow Carleton, a dapper man who favored blue shirts with white collars and tightly knotted ties and who drove a magnificent Packard convertible. Some mornings in those early years, Carleton would have his resplendent vehicle brought out of its garage, and he would drive over to Jones's apartment at 30 Sutton Place, and the two of them would proceed down the east side with the roof off, trading predictions about the market. Jones kept a Royal typewriter on his desk and a dictionary mounted on a stand. There was a stock exchange ticker with a glass dome over it, an electromechanical calculating machine that you cranked by hand, and a couch on which Jones liked to nap after his lunches. 26 Jones set out to see whether he could translate the chart watcher's advice into investment profits. But it was the structure of his fund that was truly innovative. The standard practice for professional investors was to load up with stocks when the market was expected to go up and to hold a lot of cash when it was expected to topple. But Jones improved on these options. When the charts signaled a bull market, he did not merely put 100% of his fund into stocks. He borrowed in order to be, say, 150% long, meaning that he owned stocks worth 1.5 times the value of his capital. When the charts signaled trouble, on the other hand, Jones did not merely retreat to cash. He reduced his exposure by selling stocks short, borrowing them from other investors and selling them in the expectation that their price would fall, at which point they could be repurchased at a profit. Both leverage and short selling had been used in the 1920s, mostly by operators speculating with their own money. 27 But the trauma of 1929 had given both techniques a bad name, and they were considered too racy for professionals entrusted with other people's savings. Jones's innovation was to see how these methods could be combined without any raciness at all. He used speculative means for conservative ends. As he said frequently, by selling a portion of his fund short as a routine precaution, even when the charts weren't signaling a fall, Jones could insure his portfolio against market risk. That freed him to load up on promising stocks without worrying about a collapse in the Dow Jones Index. You could buy more good stocks without taking as much risk as someone who merely bought. As Jones put it, 28, whereas traditional investors had to sell hot companies like Xerox or Polaroid if the market looked wobbly. A hedged fund could profit from smart stock picking even at times when the market seemed overvalued. In a prospectus distributed privately to his outside partners in 1961, Jones explained the magic of hedging with an example. 29. Suppose there are two investors, each endowed with $100,000. Suppose that each is equally skilled in stock selection and is optimistic about the market. The first investor, operating on conventional fund management principles, puts $80,000 into the best stocks he can find while keeping the balance of $20,000 in safe bonds. The second investor, operating on Jones's principles, borrows $100,000 to give himself a war chest totaling $200,000, then buys $130,000 worth of good stocks and shorts $70,000 worth of bad ones. This gives the second investor superior diversification in his long positions, having $130,000 to play with. He can buy a broader range of stocks. It also gives him less exposure to the market. His $70,000 worth of shorts offsets $70,000 worth of longs, so his net exposure to the market is $60,000, whereas the first investor has a net exposure of $80,000. In this way, the hedge fund investor incurs less stock selection risk and less market risk. It gets better. Consider the effect on Jones's profits. Suppose the stock market index rises by 20%, and, because they are good at stock selection, the investors in Jones's example see their longs beat the market by 10 points, yielding a rise of 30%. The short bets of the hedged investor also turn out well. If the index rises by 20%, his shorts rise by just 10% because he has successfully chosen companies that perform less well than the average. The two investors' performance will look like this. Traditional investor, hedged investor, 30% gain on $80,000 worth of stocks, 30% gain on $130,000 worth of stocks, 10% loss on $70,000 worth of shorts, gain $24,000 net gain. $39,000, $7,000 equals $32,000. The result appears to defy a basic rule of investing, which is that you can only earn higher returns by assuming higher risk. A hedged investor earns a third more, even though he has assumed less market risk and less stock selection risk. Now consider a down market. The magic works even better. If the market falls by 20%, and if the stocks selected by the two investors beat the market average by the same 10-point margin, the returns come out like this. Traditional investor, hedged investor, 10% loss on $80,000 worth of stocks, 10% loss on $130,000 worth of stocks, 30% gain on $70,000 worth of shorts, loss $8,000 net gain, $21,000, $13,000 equals $8,000 in sum. The hedged fund does better in a bull market despite the lesser risk it has assumed, and the hedged fund does better in a bear market because of the lesser risk it has assumed. Of course, the calculations work only if the investors pick good stocks. A poor stock picker could have his incompetence magnified under Jones's arrangement. Still, given the advantages of the hedged format, the question was why other fund managers failed to emulate it. The answer began with short selling, which, as Jones observed in his report to investors, was a little-known procedure that scares away users for no good reason. 30. A stigma had attached to short selling ever since the crash and was to survive years into the future. Amid the panic of 2008, regulators slapped restrictions on the practice. But as Jones patiently explained, the successful short seller performs a socially useful contrarian function. By selling stocks that rise higher than seems justified, he can dampen bubbles as they emerge. By repurchasing the same stocks later as they fall, he can provide a soft landing. Far from fueling wild speculation, short sellers could moderate the market's gyrations. It was a point that hedge fund managers were to make repeatedly in future years. The stigma nonetheless persisted, but there were other reasons why rival investors had not deployed the Jones method. Up to a point, shorting bad stocks is no more difficult than buying good ones. It involves the same intellectual process, only inverted. Instead of seeking out stocks with fast earnings growth, you look for slow earnings growth. Instead of identifying companies with strong management, you look for companies led by charlatans. In other ways, however, shorting is harder. Because of the prejudice against it, shorting faces tougher tax and regulatory treatment. And whereas the investor who buys a stock can potentially make infinite profits, the short seller can only earn 100%, and that is if the stock falls to 0.31. Moreover, shorting only works as part of a hedging strategy once a further refinement is brought in. It was here that Jones was way ahead of his contemporaries. The refinement begins with the fact that some stocks bounce up and down more than others. they have different volatilities. Buying $1,000 worth of an inert stock and shorting $1,000 worth of a volatile one does not provide a real hedge. If the market average rises by 20%, the inert stock might rise by only 10 points while the fast mover might shoot up by 30. So Jones measured the volatility of all stocks, he called it the velocity, and compared it with the volatility of Standard & Poor's 500 Index 32 for example. He examined the significant price swings in Sears Roebuck since 1948 and determined that these were 80% as big as the swings in the market average. He therefore assigned Sears a relative velocity of 80. On the other hand, some stocks were more volatile than the broad market. General Dynamics had a relative velocity of 196. Clearly, buying and selling the same number of Sears and General Dynamics stocks would not provide a hedge. If the Jones Fund sold short 100 shares of volatile General Dynamics at $50, for example, it would need to hold 245 shares in stodgy Sears Roebuck at $50 to keep the fund's market exposure neutral. In his report to his investors, Jones explained the point this way: we sell short 245 shares in Sears Roebuck at $50 equals $12,250. 100 shares in GD at $50 equals $5,000. $12,250 x Sears's velocity. 0.80 equals $9,800. $5,000 x GD's velocity. 1.96 equals $9,800. Jones pointed out that the velocity of a stock did not determine whether it was a good investment. A slow-moving stock might be expected to do well. A volatile one might be expected to do poorly. But to understand a stock's effect on a portfolio, the size of a holding had to be adjusted for its volatility. Jones's next innovation was to distinguish between the money that his fund made through stock picking and the money that it made through its exposure to the market. Years later, this distinction became commonplace. Investors called skill-driven stock picking returns alpha and passive market exposure beta 33, but Jones tracked the different sources of his profits from the start, revealing the facility with statistics he had honed amid Akron's industrial tension. Each evening, sometimes with the help of his children, he would look up the closing prices of his stocks in the World Telegraph or the Sun and note them in pencil in a dog-eared leather book. 34. Then he would construct chains of reasoning like this one. 35-hour-long stocks, worth $130,000 should have gone up by $1,300 to keep pace with the 1% rise in the market, but they actually went up by $2,500, and the difference, attributable to good stock selection, is $1,200 or 1.2% on our fund's $100,000 of equity. Our short stocks, worth $70,000, should have gone up also by 1%, which would have shown us a loss of $700, but the actual loss was only $400, and the difference, attributable to good short stock selection, is a gain of $300 or 0.3%. Being net long by the amount of $60,000, the market rise of 1% helped us along by 1% of $60,000 or $600 or 0.6%. Our total gain comes to $2,100 or 2.1% of equity. 1.5 percentage points of the return were attributable to stock selection. The remaining 0.6 percentage points stemmed from exposure to the market. Jones's calculations were impressive on two levels. In the pre-computer age, figuring the volatility of stocks was a laborious business, and Jones and his small staff performed these measurements for about 2,000 firms at 2-year intervals. But, more than Jones's patience, it was the conceptual sophistication that stood out. In a rough and ready way, his techniques anticipated the breakthroughs in financial academia of the 1950s and 1960s. In 1952, 3 years after Jones had launched his fund, modern portfolio theory was born with the publication of a short paper titled Portfolio Selection. The author was a 25-year-old graduate student named Harry Markowitz, and his chief insights were twofold. The art of investment is not merely to maximize return but to maximize risk-adjusted return, and the amount of risk that an investor takes depends not just on the stocks he owns but on the correlations among them. Jones's investment method crudely anticipated these points. By paying attention to the velocity of his stocks, Jones was effectively controlling risk, just as Markowitz advocated. Moreover, by balancing the volatility of his long and short positions, Jones was anticipating Markowitz's insight that the risk of a portfolio depends on the relationship among its components. 36. Jones's approach was more practical than that of Markowitz. For years, the 1952 paper was ignored on Wall Street because it was impossible to implement. Working out the correlations among 1,000 stocks required almost 500,000 calculations, and the requisite computer power was not yet available. In the mid-1950s, Markowitz attempted to estimate correlations for just 25 stocks, but he found that even this demanded more computer memory than the Yale economics department could provide for him. And so it fell to another future Nobel laureate, William Sharpe, to develop a variation that would render Markowitz's work useful. In a paper titled A Simplified Model for Portfolio Analysis, Sharpe replaced the hopeless injunction to calculate the multiple relationships among stocks with the simpler idea of calculating a single correlation between each stock and the market index. This was precisely what Jones's velocity calculations were designed to do. By the time Sharpe published his paper in 1963, Jones had been implementing its advice for more than a decade. Jones also anticipated the work of James Tobin, another Nobel Prize-winning father of modern portfolio theory. In 1958, Tobin proposed what came to be known as the Separation Theorem, which held that an investor's choice of stocks should be separate from the question of his risk appetite. Most investment advisors in the 1950s assumed that certain types of stocks suited certain types of investor. A widow should not own a go-go stock such as Xerox, whereas a successful business executive should have no interest in a stodgy utility such as AT&T. Tobin's insight was to see why this was wrong. An investor's choice of stocks could be separated from the amount of risk he wanted. If an investor was risk-averse, he should buy the best stocks available but commit only part of his savings. If an investor was risk-hungry, he should buy exactly the same stocks but borrow money to buy more of them. Yet 9 years before Tobin published his groundbreaking article, Jones was onto the same point. His fund made one judgment about which companies to own and a second about how much risk to take, adjusting the risk as it saw fit by using the device of leverage 37 in the 1950s and into the 1960s. Almost nobody understood Jones's investment methods, in his secrecy as in much else. Jones anticipated the future of the hedge fund industry. His clandestine activities in Europe had taught him how to stay under the radar, and he had multiple reasons to approach finance in the same fashion. 38 To begin with, Jones wanted to protect his investment methods from competitors. Brokers who visited the A.W. Jones offices on Broad Street were cross-examined vigorously about the stocks they were touting, but they left the place with no idea what the Jones men were thinking. Equally, Jones wanted to avoid drawing attention to the tax loopholes devised for him by Richard Valentine, an attorney at the firm of Seward and Kissel. Valentine was a creative genius who could be cartoonishly absent-minded in his personal dealings. He once phoned a colleague's home and launched into a lengthy exposition of his latest tax idea. Oblivious to the fact that he was talking to his colleague's 5-year-old 39, it was Valentine who realized that if managers took a share of a hedge fund's investment profits rather than a flat management fee, they could be taxed at the capital gains rate. Given the personal tax rates of the times, that could mean handing 25% to Uncle Sam rather than 91%. 40 Jones duly charged his investors 20% of the upside, claiming that he had been inspired to do so by Mediterranean history rather than tax law. He told people that his profit share was modeled after Phoenician merchants, who kept a fifth of the profits from successful voyages, distributing the rest to their investors. Dignified by this impressive cover story, Jones's performance fee was happily embraced by successive generations of hedge funds. Jones's reasons for secrecy went beyond a desire to stave off competitors and reduce tax. He was anxious to escape regulation. He declined to register under the Securities Act of 1933, the Investment Company Act of 1940, and the Investment Advisors Act of 1940, arguing that none of these laws applied to him, principally because his funds were private. Not registering under these laws was essential. They restricted investment funds from borrowing or selling short, the two central components of Jones's hedging strategy, and also imposed fee restrictions. To sustain the idea that his funds were private, Jones never advertised them publicly. He marketed them by word of mouth, which sometimes meant a word between mouthfuls at his dinner table. Much of his capital came from his network of intellectual friends, including Louis Fisher, a biographer of Lenin, and Sam Stamen, the inventor of the bridge convention. Stamen over no Trump. 41 Jones also took care not to allow too many investors into his fund. In 1961 he set up a second partnership rather than allow his first one to cross the permissible threshold of 100 members. 42 This stealth allowed Jones and his later imitators to escape regulatory oversight, but it came at a price. There is nothing like secrecy to pique the public's curiosity, and by the mid-1960s, hedge funds had begun to attract the sort of breathless commentary that later grew commonplace. They were Wall Street's last bastions of secrecy, mystery, exclusivity, and privilege, according to the writer John Brooks. They were the parlor cars of the new gravy train. 43 Perhaps the threat of deadening regulation made Jones's clandestine style inevitable. But thanks to the pattern that he established in those early years, hedge funds have been forever mysterious, shadowy, and resented. Even as he anticipated the insights of modern portfolio theory, Jones paid a price for ignoring Alfred Cowells's writings. The verdict that trends in market prices are too faint to be profitable proved all too correct, at least in Jones's case. His efforts to call the overall direction of the market failed as often as they succeeded. In 1953, 1956, and again in 1957, Jones lost money on his market calls, leveraging himself up when the market did poorly and vice versa. In 1960, Cowles published an update to his earlier research. He reversed his earlier finding of faint trends in monthly prices, concluding that they did not exist after all 44 oblivious. Jones carried on trying to time the market, but with no better results. In early 1962, he was net long 140% of his capital, whereupon the market fell. Then he turned bearish, but the market turned up. At one particularly excruciating moment in August 1965, Jones had a net exposure of minus 18%, meaning that his short positions exceeded his longs to the tune of 18% of his fund's capital. Perfectly on cue, the market embarked on a hot rally. Future hedge fund managers were to prove that trend surfing can be profitable, and future academics were to revise Cowles's findings. But Jones never turned a profit by following the charts. Even though Chartism had provided the premise for his hedge fund 45, Jones's statistical methods revealed precisely how much money he was losing from bad calls on the market 46, but his funds still performed marvelously. The reason lay in a discovery that he had stumbled upon almost accidentally. He had begun with theories about trends created by investor sentiment, which turned out to be blind alleys. He had invented the hedge strategy, which was conceptually brilliant but not in itself a source of profits. Next, having designed a hedge portfolio, he needed to choose stocks to put inside it. Through skill and a coincidence of temperament, Jones devised a way of assembling stock pickers who beat the pants off Wall Street. Jones knew he could not be a great stock picker himself. He was an investment novice, and the details of company balance sheets had never captured his imagination. Instead, he created a system to get the best out of others. Starting in the early 1950s, he invited brokers to run model portfolios for his fund. Each man would select his favorite shorts and longs, and phone in changes as though he were running real money. Jones used these paper portfolios as a source of stock-picking ideas. His statistical methods, which separated the fruits of stock selection from the effect of market moves, allowed him to pinpoint each manager's results precisely. Jones then compensated the brokers according to how well their suggestions worked. It was a marvelous technique for getting brokers to phone in hot ideas before they gave them to others. 47. This system gave Jones an edge over his competitors. In the 1950s, Wall Street was a sleepy, unsophisticated place. At the universities and business schools, practically nobody took courses in finance. The investment course at Harvard was dubbed Darkness at Noon because the university administrators allocated it the unpopular lunchtime slot in order to save classroom space for more popular subjects. The trustees at the old investment institutions were compensated by the volume of assets under management rather than by a performance fee, and they reached decisions by committee. Jones's method broke the mold. It was each stock picker for himself. It substituted individualism for collectivism and adrenaline for complacency. Even in the 1960s, when Jones's enterprise had grown big enough to have half a dozen stock pickers on its payroll, he continued to cultivate a Darwinian system. He convened remarkably few investment meetings because he found committees intolerably tedious. 48. Instead, he allotted each in-house manager a segment of the partner's capital, laid down the desired market exposure, and left him to invest the money. At the end of each year, the managers who performed best were also the best rewarded. You could see the results in the way the Jones men operated. In the Wall Street of the 1950s and 1960s, information did not reach everyone at once. There were no blast emails from brokers, no instant analysis from cable TV squawkers. In this environment, the investment team with the most hustle could beat out sleepier rivals, and the Jones men hustled hardest. The model portfolio managers rushed to call in hot ideas, and the in-house segment managers worked the phones, scrambling for the gossip and insights that would put them ahead of their competitors. Even in the 1960s, when Wall Street finally shrugged off its post-crash stupor, it was surprising how easily sheer diligence could set a man apart. Alan Drescher, one of the Jones stock pickers, had the idea of going over to the Securities and Exchange Commission offices to read company filings the moment they came out. The extraordinary thing was that he was all alone. The rest of the street was waiting for the filings to arrive in a bundle from the post office. The linking of compensation to results was the key to Jones's formula. When a broker passed a stock tip to a normal mutual fund, there was no certain connection between the quality of the tip and what the broker would be paid for it. For one thing, the mutual funds lacked Jones's system for tracking how stock recommendations turned out. For another, mutual fund companies paid out thousands of dollars to salesmen who brought in investors' capital, leaving little money over to reward excellent research. Jones, on the other hand, was meticulous in paying for good research ideas, and he paid handsomely. 49. A young broker could see his salary double if the recommendations in his model portfolio generated profits. 50. Meanwhile, the fund's performance fees were divvied up among Jones's in-house money managers according to whose segment did best, and Jones devised 2 further ways of sharpening incentives. Each year, successful segment managers were given extra capital to manage, which increased their chances of generating profits in the coming year and so earning a large bonus. Unsuccessful managers received less capital to play with, and in another innovation that anticipated the hedge funds of later times, Jones required his partners to have their own capital in the funds, so that their wealth as well as their income was riding on their performance. 51. Without realizing the significance of what he was doing, Jones had created the competitive multi-manager structure that has been used to great effect by later generations of hedge funds. As we shall see in Chapter 3, the same structure was reinvented in the 1970s by a firm in Princeton, New Jersey, and later dozens of hedge funds came to use it. But in the 1950s and 1960s, the combination of Darwinist individualism and top-down risk control was almost unique to Jones, and this gave him a powerful advantage. The market may be efficient, in the sense that information is reflected in prices to the extent that existing institutional arrangements allow. But Jones blew up those institutional arrangements, scrapping staid committee meetings and paying people to perform. Thus did he create the edge that brought in serious money. At the start of 1964, Alfred Jones invited a young analyst to lunch at his Manhattan club. Now in his 60s, he had achieved the material comfort he had sought 15 years earlier. His family had graduated from its Dodge station wagon to a Citroën DS and finally to a monstrous Mercedes. Jones peered at the young analyst and asked, "When you go to pee in a restaurant urinal, do you wash your hands before or after you pee?" The analyst was a bit surprised. "Afterwards, sir," he ventured. "That's the wrong answer," Jones retorted. "You're a conventional thinker and not rational." 52. Jones was trying to be funny. He was recycling a version of a joke that was doing the rounds, but he had mangled it hopelessly. The analyst, a future Wall Street grandee named Barton Biggs, took instantly against Jones. And although he accepted the opportunity to run a model portfolio for his fund, he never grew to like him. Jones seemed aloof, conceited, and ignorant about stocks. He was reaping the fruits of young analysts' hard work while himself appearing in the office sporadically. Perhaps not surprisingly, the man who had spent his early adulthood among clandestine anti-Hitler activists never had much passion for investing. He disdained the monomaniacal market types with no interests beyond finance. "Too many men don't want to do something after they make money. They just go on and make a lot more money," he complained to one interviewer. 53. Jones cultivated literary infatuations. He was enthralled by the theory that Edward de Vere, the 17th Earl of Oxford, was the true author of Shakespeare's plays, and he named his poodle Edward. He carved a tunnel through the weeping willows at his country house and nursed his lawn tennis court as though it were a sickly infant. He founded a philanthropy devoted to what he called the humiliated poor and set to work on a book that he intended as a sequel to Michael Harrington's famous poverty study, The Other America. Dorothy Parker was now too drunk to be invited over much, but Alfred and Mary entertained a cosmopolitan cast of intellectuals and United Nations diplomats, and dinner conversation was less likely to be about finance than about Russian hegemony in Yugoslavia. 54. It was not surprising that committed Wall Streeters resented him. Soon after Jones's lunch with Biggs, the resentments burst out into the open. One of Jones's in-house money managers left to set up a rival hedge fund called City Associates. 55. From the point of view of the defector, the choice was rational. The hedge concept was easy to copy, and there was no need to share the loot with a dilettante overseer. Jones had his lawyers harass his departing partner, but the old man took the blow in stride, and at the end of 1964 he spent his Christmas vacation on a Himalayan tiger shoot hosted by Indian friends from the United Nations. There were elephant-back outings, a big bonfire and fine food, and incongruous sessions in which the Hindu host sang Christmas carols. But while Jones was away, more trouble was brewing. Barton Biggs, the audience for Jones's urinal joke, persuaded Jones's longest-serving fund manager to quit and start up a rival fund. On his way out the door, the defector took some of Jones's clients with him. 56. Sooner or later, every great investor's edge is destined to unravel. His techniques are understood and copied by rivals. He can no longer claim to be more efficient than the market. Jones's extraordinary profits had fostered jealousies among the partners about how the money should be shared. And after the first 2 defections, others inevitably followed. At the start of 1968, there were said to be 40 imitator firms. By 1969, estimates ranged from 200 to 500, and many of the leading lights were run by people who had worked for Jones or served him as brokers. 57. The Economist claimed that this new investment industry had about $11 billion under management, or 5 times the figure of 2 years earlier. 58. The expression hedge fund a corrupted version of Jones's hedged fund, entered the Wall Street lexicon. 59 Every sideburns gunslinger was determined to work for one. The early effect of this unraveling was paradoxical. As the first imitator funds sprang up, word got about the street, and Jones came to be seen as the founder of a hot new movement. A flattering profile appeared in Fortune in 1966. There are reasons to believe that the best professional manager of investors' money these days is a quiet-spoken, seldom photographed man named Alfred Winslow Jones. The article began, though somehow Fortune had obtained a large photo of Jones, showing him with a thick thatch of white hair and large dark-framed glasses. 60 investors fell over one another to get money into the Jones funds. Ambitious young analysts came looking for jobs, and for a while the party continued. 61 Jones himself was said to be earning something in the millions, and the Jones defectors were raking in the money too. One City Associates partner acquired a penthouse, a helicopter, a wine cellar, and bodyguards. His office was staffed by curvaceous women who allegedly were secretaries. 62 It all added to the gossip and the envy and fun. Hedge funds embodied the spirit of the age, and as New York Magazine proclaimed in 1968, a W. Jones was their big daddy. The boom attracted the attention of regulators, much as other hedge fund booms did later. In 1968, the New York Stock Exchange and the American Stock Exchange began to consider restrictions on their members' dealings with hedge funds. In January 1969, the Securities and Exchange Commission sent out a questionnaire to 200 hedge funds, demanding to know who they are, how they came into being, the way in which they are organized, and especially what impact their trading may have on the market. 63 Commission officials made no secret of the fact that they wanted hedge funds to register under one of the federal acts, but some of the complaints about the new upstarts seemed a bit curious. It was said that hedge funds accounted for half the short interest in certain stocks. Nobody explained why this short selling, which presumably prevented indifferent companies from attaining unsustainable market valuations, might be pernicious. It was noted that hedge funds turned over their portfolios more aggressively than mutual funds, but somehow this boost to market liquidity was portrayed as a bad thing. There was a tall story about an A.W. Jones manager who bought a large block in a go-go company one morning and sold it after lunch. Nobody could explain how this alleged crime harmed anyone. However much they might be envied and adored, hedge funds were also the object of not quite rational resentment. In the 3 years starting in the summer of 1966, Jones's investors pocketed returns, after subtracting fees, of 26%, 22%, and 47%. 64 But this Indian summer concealed trouble. The Jones funds were losing their distinctive edge, their stock pickers were defecting to set up rival firms, and Jones's hedging principles no longer seemed so relevant. The hedge fund model deserved to drop its D, caught up in the bull market. The Jones men came to regard shorting as a sucker's game and lost interest in protecting the fund against a fall in the S&P 500. Instead, they pushed the boundaries of leverage. Each segment manager was out to buy as many go-go stocks as possible. Even the velocity calculations fell by the wayside. The Jones men did not like being told to buy less of a hot stock merely because it might be volatile, because the stock market was roaring, and because Jones himself was increasingly absent. The stock pickers did what they wanted. 65 This was the 60s. They were young. The market belonged to their generation. For most of his financial life, Jones had been lucky. He had opened his hedge fund just as the trauma of the crash was beginning to wear off. In 1950, only 1 in 25 American adults owned stocks. By the end of the 1950s, 1 in 8 did. 66 As retail brokerages sprang up on every high street, the S&P 500 index rose from 15 at the time of Jones's launch to a peak of 108 in late 1968. And meanwhile the financial culture changed. The trusty bankers were eclipsed by go-go types for whom the crash was ancient history. The new generation believed that financial turmoil would never rear its head again. The Fed was watching over the economy. The SEC was watching over the market, and Keynesian budget policies had repealed the tyranny of the business cycle. This state of blissful optimism found its apotheosis in the Great Winfield, the semi-fictional investor immortalized by Jerry Goodman, the financial writer and broadcaster who became famous under the pseudonym Adam Smith. The Great Winfield entrusts his money to 20-something managers with no memories and no fear, whose chief virtue is inexperience. Show me a portfolio, I'll tell you the generation, he says. You can tell the swinger stocks because they frighten all the other generations. 67 Jones had caught the go-go era early. The portion of his wealth, though certainly not all, was the result of riding a long bull market. But the multi-manager structure that empowered go-go segment managers was not designed to save Jones from a sudden reversal, a problem that multi-manager hedge funds were to discover later. On the contrary, the more the market rose, the more Jones's performance tracking system rewarded aggressive segment managers who took the most risk. There was no mechanism for getting out before disaster struck, and in May 1969 the stock market started to fall hard, shedding a quarter of its value over the next year. When Jones reported his results for the year ending in May 1970, he was obliged to tell his clients that he had done even worse than the market. He had lost 35% of their money, 68% the following September. Jones marked his 70th birthday. It was a time of celebration for his family. Jones's daughter-in-law was expecting his first grandchild, and his daughter's wedding engagement was announced at the birthday party. A marquee was put up on the lawn of his beloved country house, up the hill from the grass tennis court that he nurtured like an infant. The band played dance music, and the young men traded guesses about who Miss Jones's betrothed might be. But the patriarch was out of sorts. He fretted that his segment managers would resent the extravagance of the occasion. "I hate the boys seeing me spending money like a drunken sailor," he kept saying, 69 after 2 decades of eminence. Jones's investment edge was gone. The markets had finally caught up with him.